If you've been following me for a while now, you know I create a lot of video content, and I cannot begin to tell you how impactful it's been for my professional career. If you want to build your brand, there's no better way than to create video content. And my company, The Content Store, helps business thought leaders do just that. I created The Content Store to help folks cut through all the trials and tribulations that I went through and fast forward right to the part where they're producing premium video content. The Content Store specializes in 3 types of content: podcasts, YouTube videos, and short form videos for social media. We believe in 3 key pillars when it comes to creating video content. Number 1, it has to capture people's attention. Number 2, and this is a big one, the video should provide value to your audience. And finally, number 3, we think your content should be authentic and showcase your true authentic self. Let the Content Store elevate your personal brand and begin your content journey today. Go to thecontentstore.com for more information. Hello and welcome back to the Art of SBA Lending. I'm your host, Ray Drew. We have a fun one today, folks. Today we're going to discuss a big idea, the possibility of combining the 7A and 504 into one program. We're talking about taking the best of both worlds and putting them together to make the ultimate access to capital program. But first, I must ask, why are there 2 programs? The 7A program, of course, came first, I think in the 1950s, which is when the SBA was created. And this program was meant to provide access to capital to small businesses and ones that can't get capital elsewhere on reasonable terms. And that would encourage economic development and create more jobs. And you can use this loan for just about anything. So why another program? Well, the 504 program didn't come until about 1980. So what was going on during that time? Well, the year prior, 1979, prime was 15, headed up. And by 1980, prime was 20. This period brought on the term stagflation, slow growth and high inflation, and high interest rates as a result. And the 504 was meant to provide a lower rate option to small businesses and get them to invest. I couldn't find the exact, but I think the first debenture rate was somewhere in the neighborhood of 8 to 10%, which was roughly half of what prime was at the time. And it was fixed, which was huge because banks were so afraid to fix their rates at that time because prime and the rates were moving so quickly. That meant businesses weren't buying real estate and other fixed assets. And this was a really great solution to a really, really big problem in our country at the time. Now, over the years, the 7A and the 504 have grown to over $35 billion a year in total originations, and entire industries have been created around them. Now, when I entered the industry in 2011, prime was 3.25, and the debenture rate on the 504 was around 5.5. It had inverted. So were 2 different programs needed during that stretch of record low interest rates? Probably not. These last few years, though, with prime shooting up, the 504 came in really handy to a lot of small business owners that chose 6 over 11% rates. But you don't need to fully price a 7A. You can charge prime minus 1.5 and give the borrower that same 6.5% rate and even fix it for life. Now, that to me is starting to sound like a 504 loan. But what about the lien on the home? Get rid of it. We're going to be talking more about this in a later episode, but essentially, if the SBA is willing to fully back unsecured loans, why penalize people who happen to park their money in real estate versus the stock market? Just get rid of it. Guys, what if we all join forces? Get rid of the 7A and the 504. Come up with a new name, maybe something a little more catchy this time. One program, allow for PLP processing, get rid of the all available collateral rule, increase the max loan to $20 million, allow every bank, credit union, SBLC, and CDC to offer this product. Ladies and gentlemen, I give you the SBA Centaur Loan. Half 7A, half 504. All right, now let's bring in our panel of Art of SBA contributors to unpack this hugely innovative idea. I'm not sure they're going to be able to poke any holes in this one, but I know they're going to try. Ladies and gentlemen, Brooke Mirenda, President and CEO of SEDCO, Ken Rosenthal, Senior Advisor at Momentous Direct Capital, and special guest Mitch Fogel, Managing Partner and Founder of Fogel Law Group. Welcome to the panel. I'm just going to go to each of you right off the bat, and I just want you to tell me if you like this idea or you don't like this idea, and why? Let's start with you, Brooke.
No. So that's it. Obviously there are two different programs. What you talked about early on is the 504 was essentially developed as this is what SBA, talks about as their premier economic development program. We have a job creation goal with every loan we do, where that is very different than the 7A. So while we do have to have a credit elsewhere reason, it's really not a credit elsewhere program. And it's really it's to create an economic impact and for business owners to effectively be able to hire more people and retain that capital to purchase a fixed asset at a lower cost. Obviously, with the 504, it's sold differently than the 7A. 504 is sold in a bond. A bond is a fixed income instrument. And so it's different than the 7A where, you got variable rates. There's a little bit more money in it to be had and to be lost. And so to me, they're two very different programs being able to finance very different needs. So again, that's why I'm not a big fan of it. I think that's where all pokes and holes.
Well, I'm not giving up on you yet, Brooke. I understand it, but you know what? We need to think bigger and think outside the box. Mitch, I know you're an innovator, man. Come on. What do we think? Yay or nay on this idea?
All right. So I think Brooke really hit on some very valid points that would need to be addressed if we were to go in this direction. The purposes are not identical. They have different goals, different objectives. Brooke pointed on some of those. There are many different types of loans within the 7A program, under the 7A umbrella, that are not loans under the 504. That doesn't mean if somebody's super creative, and this would be a major undertaking because you see how difficult it is to get things done within the government and the SBA anyway, to make something new, just make changes to what we have. So for example, you've got import, export, XLOC loans, you've got stuff for working capital, you've got, franchise, you've got so many different things in the 7A bucket that you don't really have in the 504. The 504 is, long-term capital assets and real estate. That doesn't mean you can't get creative and make this happen, but I also like there to be options, and they are priced differently. And just because interest rates intersect or swap at any given time isn't, I think, a great justification for combining the two programs. But, people do use 7A loans for real estate. And now you can use 504 loans for a few neat twists, like partner buyouts within, an EPC. So it's kind of like, the lines are blurred a little bit. And there are those of us in the industry, and I've been doing this almost throughout 30 years, which is about half as long as Ken's been doing this. And I've seen a lot of changes over time. Brooke still, she's 30 years old, so she's only been doing this for, I don't know, whatever, but those in age. Having said that, there are compelling reasons why to keep them separate. And there are people in this industry who have been vehemently all in 504, would never ever consider 7A, and all in 7A and would never consider 504. And that's changed too. So you're right. I like to be on the cutting edge. I'm open-minded about stuff. I try to be creative. So I think at this point, it would be a major undertaking. And I would say, more power to you, Ray. If you want to be the leader on this, God bless you.
Well, I appreciate those insights. And, I knew I was going to be a little bit stacked here up front, but, by the end of this, I'm confident that I will get all of you on board.
Okay.
Now, Ken, what do you think about the idea? Let's just get your take in here, and then I'm going to pivot to some more pointed questions.
So first of all, 34 years in the business, and I started when I was 7, Mitch. And a little education for those out there as well as Ray. Before Ray was maybe even born, there was a program called a 502. Mm-hmm. And the 502 really was a 504 7A in disguise because it looked a lot like 7A. So actually, it's not a new idea. The 502 was a kind of a combination of the two programs. And they got rid of it and went to a 503, and then they went to a 504, and now you're talking about going to a 505 or Centurion, which I not only don't like, I hate. for all the reasons that were already mentioned. And on top of that, I have a better solution. And the solution is very simple. And that is $5 million cap for each program separately. Not only are they not combined, you make them completely separate so that 7A does their thing and they have $5 million in SBA guarantee authority, and 504 does their thing. Why should I be penalized because I buy a big building and I'm going to use $5 million? Now I don't have any money for working capital or whatever the 7A is. That separates the two because the two have completely different reasons, different economic development objectives, and different business perspective objectives. Booyah!
Well, that was you came with some facts. I will give you that. But let me think about that. In the meantime, I'm going to Mitch. So would you concede that if there was a product that could be priced anywhere from, you could price however you want, prime -2, prime +2, whatever, and it had the best of both worlds, so like no taking additional collateral, but super streamlined process, and you just took all the things that people liked from each program and combined it into one, just from the market standpoint, from a small business owner standpoint, doesn't that sound like a superior product for the small business owner?
Well, I think at 30,000 feet, where it's easy to take a look at things like this and come up with a conclusion that may be a conclusion you could reach. I think in a lot of ways, the consumer, the borrower, is very confused, can be confused by all the financing options that are available to them anyway. I'm not in sales. I'm like the tail wagging the dog a little bit. I kind of come in when, Ken and Brooke have kind of done their jobs and landed the borrower, and the borrower's been educated in what's available to them: conventional financing, 7A financing, 504 financing, what's available to them. If you throw more product in, my concern would be, and I don't want to dismiss the intellectual capabilities of a borrower, but I can tell you just in my experience closing the deals I've done, they don't even understand a lot what they're doing, and you're getting it anyway. And it's been explained to them multiple times. I can't tell you how many times that I've closed 7A deals and more frequently 504 deals where the borrower doesn't remember how their interest rate is set, doesn't remember what their responsibilities are, doesn't remember what's eligible and not eligible. So to add an additional line may be worth it, maybe the better solution. And I'll build on Ken's suggestion. Although I don't know why Ken picked 5 million as the cap. I think 5 million as the cap is sailed. I think I'm an advocate for bumping that up 7.5, 8, 10 million. It's unrealistic, I think.
You're not going to get Congress to agree to it.
Oh, it'll be difficult. I agree, but they've done it before. Look, we went from
they'll do it 5 each though.
Back when, and things don't cost what they did in 2010 when the American Recovery Act, the ARA was done. So it's been 14 years. It's been a long time. So I think that needs to be revisited. But having said that, and also, by the way,
we agree on.
Yeah, when you get into larger deals, you do get a more sophisticated borrower too. So I like the idea of what Ken's got. I've never understood why you have to have one or the other. You could do both. I also, I've seen just in the deals that I have done, I used to do in the 90s, early 2000s, and the sophistication of the borrowers has changed radically. So, I say adding another facility, another product, maybe is very complicated.
Okay, fair point. But, I gotcha.
Some people will process that.
And Brooke, it sounds like a storm's rolling in over there in
Can you hear it?
in your
Sorry,
neck of the woods.
I need to move myself.
No, I'm not sure if that's like a metaphor for, the Centaur program is coming and it's going to take everyone by storm. If you've been a fan of the show for a while, then one of my favorite companies to work with is Rapid Business Plans. Last year alone, their business plans helped facilitate over $600 million in government guaranteed lending. They're on track to beat that this year. More and more small business lenders and their borrowers are relying on Rapid to help with the business plan, projections, and assumptions because their team goes the extra mile to ensure everything is done fast and done right. And that helps streamline the process. They're great at export business plans, by the way, which are critically important at protecting that 90% guarantee. Rapid also offers feasibility studies, which tells you if the project is, well, feasible. I would recommend these for any large startup loan because it protects you and it protects the borrower and helps you get more good deals done. Go to rapidbusinessplans.com to set up your Get Acquainted call today. Find out why so many top producing BDOs recommend Rapid to their small business borrowers. We're going to leave a link in the show notes just for our Art of SBA listeners. Now let's get back to the show. So Brooke, what is the downside of this? My idea, just entertain me. Like if we were to do this, can we think of a specific downside for the borrower? Can we think of a specific downside for the federal government, who's our partner in all these programs?
So a couple things. So you talked about interest rates. And so there can be Advantage 7A and then there can be Advantage 504. So if you combine them and there's not another option, do you know what I'm saying? So there's not another advantage if rates all go up and it's all tied to prime and prime goes up, there's no other option. And so that would be one thing. The second thing is funding. I mean, the way people don't understand the way 504s are funded is vastly different than the way 7As are funded. The lender, it's like the PPP thing. The lender's writing a check effectively to the borrower, to the business owner getting the loan, and then selling that portion in the secondary market, whether in a pool or individually, and then getting that, either premium back. I mean, they can participate it. So right now with CDCs, Zenco's not writing a check when we fund a loan. It goes in the secondary market as a bond and gets sold, all together in secondary market as a bond. So how would you untangle that, unwind that? And then who's funding all of those? CDCs aren't equipped to necessarily write a check. So that would almost eliminate CDCs, which is, my lifeblood. So
that's what Ray wants to do.
I'm like, oh, that stinks. But that's kind of, so I think about the two things, funding, and then who are we trying to help? The small business owners. So if there's not an advantage, because when you got working capital and that's all they need, you're gonna charge them what you would charge if someone has a fixed asset with full collateral. That doesn't seem fair or right. But and I think the investor would feel the same way. So
okay, well, you've managed to poke a couple minor holes in my idea, but you know what? We have tape, and we're gonna keep going.
Okay,
Ken, let's talk about your livelihood, the secondary market, wholesale market, 7A 504. You think these buyers of this type of paper would be able to pivot, your groups and like the 7A secondary market? Can everyone just pivot to my idea and buy that paper going forward, do you think?
From a wholesale perspective and a secondary market perspective, a little bit different. Secondary market being 7A, wholesale 504. The players I deal with are all about CRA. So frankly, they don't care as long as they get the CRA credit. Morgan Stanley, New York Life, that's what they want, a CRA. So if you could get CRA credit, sure. But the sledgehammer into your idea is you have two completely different types of lenders. You have CDFI, economic development lenders in the CDC world, and you have bankers on the 7A side that have a completely different mentality. And that's one of the reasons why SBA doesn't want banks to be CDCs. It's just a different mentality. That might be the reason why Community Advantage is limited to 350. It's a different mentality.
Mm-hmm.
They need to be separate because they're different objectives and different groups lending on them. Look, if banks would be willing to do $50,000, $100,000 loans, you would need CA. But guess what? They don't. And so therefore you do need CA, Community Advantage, which are done by economic development people, not bankers. So you need to have both.
Maybe. We'll see. All right, let's analyze this from a lender risk standpoint. Okay, so 504 first mortgage lenders have almost no risk. Do you think, Brooke, that if those lenders had a 75% guarantee on a 90% LTV deal, is that enough mitigation on a 90% loan to value deal for those banks who are currently using the 504 to continue lending?
Yes and no, because some of them like to sell that portion of the secondary market. So I wonder how that would foul that up. The ones that aren't, they still, you still got the guarantee, but a lot of I think it's over 80% sell the secondary market for the, their capital. So I guess that, that would be, to me, I kind of punt that back to you and say, well, what happens in that sense? Or are these big banks that don't sell? You know what I mean? What are they doing? And then the smaller banks that are selling, what does that look like? To me, the risk for, when you're talking about, when you have an asset, lenders are typically doing 70-75% loans anyway. So sure, if you're talking about a higher guarantee, yeah, but at the same time, they'll do a 70-75% loan anyway on owner occupied.
Yeah,
And
but
so,
they're going to do a 90 though. So, but if they do a
Right.
90, that's more. And then
Right.
if they liquidate it and they only get 85 cents on the dollar, and then they have a 75% guarantee.
Right.
I mean, then they have a couple, 3%, exposure or whatever,
Sure.
something small,
That's what
but
I'm
there
saying.
is some.
I mean, my short answer would be yes. But then I'm like, I think about the reason, what the other counterpart is. And that's typical, right now, the way it works is the capital situation of being able to sell that portion. Do they have to hold it all then? Like, what would that look like? Does that make sense?
Well, we're going to turn all that on its head and figure out that later.
Okay.
But for now, we're doing a thought exercise. So, all right, Ken, help me clarify something. So the 7A is access to capital. The 504, on the other hand, is below market interest rate, which in unprecedented times like 1980, I totally understand. But why should the federal government be subsidizing interest rates in today's environment?
Federal government's involved in both programs. So all they do on the 504 debenture is they guarantee the bond sale. That's a separately negotiated instrument on Wall Street. Federal government doesn't set the rate. It right now is around 2 over 10-year treasuries because investors on Wall Street say, I can buy this full faith and credit instrument. It's known as a 504, whatever that is, or I could buy a 10-year treasury. And they want a premium above treasuries. So there is that premium. The government is actually not funding it. They're just guaranteeing the bond sale.
So why is the rate lower? Who decides that?
It's just the
Market.
people buying this note on Wall Street, and they're buying a full faith and credit 25-year instrument and saying, I'm going to buy this 25-year fixed rate instrument because I'm taking this money and it's, mostly insurance type money, and they're going to put it there for a long time, or at least say around 8-9 years, which is the average payoff. They could buy a 10-year treasury, or they could buy this. It's just another option, but it is 10-year treasuries are fixed too. So it's really just another option for the investors. The 7A market is a totally different model, and the government's not lending that money directly either, right? It's all a government guarantee. That's the whole point of both of these, whether it's Centaur, 504, 7A, 505. The government's not lending the money. The private sector is doing it with the government guarantee. The taxpayer is not using their money. Taxpayer money only goes to pay for the government offices. Other than that, it is a zero subsidy, which means it doesn't cost anybody but the users. Everybody pays in the fees to cover potential losses. So I don't know about the Centaur program, but 504 and 7A, the government's not lending the money.
All right. Well, I should have invited dumber people on here. But here, let me keep going because you know what? This is a thought exercise. And so, Mitch, what if the federal government opened up a facility that SBA Centaur lenders could borrow from at 2% below the Fed funds rate, but only if we pass those savings on to the customer? Now you have an even more attractive rate, a streamlined process, and a simplified collateral policy. So, did I get you on board?
No. And for a number of reasons. First of all, from what I just understood what you said, did you just create a competitor to the 7A and the 504 and all the banks that have been in good faith operating under this system and the CDCs that have been putting money out there? I did not hear you say that, did I? So if I did, then maybe I misunderstood. But if I did,
it's exactly what I said.
That would be a really bad idea. So I'm going to give you a little bit more history because I'm old. So back in the 1980s, when I was in law school, the SBA did exist, obviously, and Ronald Reagan was president. And I had a job interview lined up for me to go get a job in Washington, D.C. and work at the SBA, which is complete irony because I never thought that I would end up back doing what I do. But that was to go work internally at the SBA. So back in those days, instead of it being on a computer, they would post something on a bulletin board. And those people that were granted interviews, their names would be on there. And so I saw my name on there. I was very excited about it. It was transactional, or so I thought. And then Ronald Reagan essentially said, we don't need this SBA. I'm paraphrasing. And he went to get rid of it. They were getting rid of the SBA because they didn't want to be in the business of making loans. It was a bad idea. And I must say that as prejudiced as this statement is, I'm incredibly impressed that we have a system that is incredibly unique to our country, where we have the private sector with, a government run program, but the private sector, as Ken so aptly described, that creates capital access to borrowers and creates returns and jobs and everything else. And essentially, to my knowledge in this business, has had very few, maybe 1 or 2 years, and maybe Ken can correct me or Brooke, where it's actually cost the American taxpayer any money. I think 2008 may have been the year in all the time I've done this where it actually flip-flopped and that it couldn't pay for itself. In fact, if I remember hearing stories correctly back in the day, they made so much money through the program that they had to redeploy it within the program and elsewhere because you can't make money in these government guaranteed programs. So I think it's an incredible system. I'd hate to see the government come in and screw it up and try to become a lender again. Look, they're already doing it with EIDL loans and disaster loans, and there's a need for that because it has to go out quickly. We saw what happened in Triple P. We can go on and on. That's another 7 episodes of, the Art of SBA Lending. But no, bad idea, not in favor of it, kerplunk.
Okay, well, what about the logo? How cool a centaur would be. All right, you know what? Just to show you guys how open-minded I am, I will admit I am getting swayed a little bit towards backing away from this idea. But since you brought it up, Mitch, I'm gonna go to Brooke with this one about the subsidies. I know we both operate with zero subsidy most years, 504(2), correct? Basically,
Yeah,
right?
correct.
Okay. And I will concede that removing the all available collateral policy would increase the loan loss rate because we wouldn't have as much collateral to liquidate. I don't know if that's going to be material or not. But since we're playing this out, since we're doing this and putting this on the internet, I need to understand how this is going to impact the government's pocketbook. Do you think if we move more towards my idea, do you think we can still maintain zero subsidy? I don't even know if it makes sense to keep going on with this episode. Let's move on. No, I'm just kidding. Yeah, I mean, I'm losing this battle. This is not good. I should have invited Charles Green to help me, back me up here.
Hey, there was a positive subsidy back before you were born.
You mean a negative?
There was a subsidy, yeah.
Yeah, sure. There had to be.
There was. But currently, the last several years, it's been zero.
Right.
I don't even know what to ask at this point.
We won. You're done.
Ding, 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 ding.
This is, and the funny part is these questions are 5 rounds, so it says round 4. So it's I just basically got knocked out in the 4th round.
Yeah. I mean, well, keep in mind with all these programs, and I don't know, I think Mitch brought this up. I'm not sure, but we say it's a public-private partnership. So, and that's, with us, you got 3 parties involved. You've got the borrower, you've got the lender, you've got us and the kind of the market. And so investors. And so when you think about that, what, I think Mitch brought this up, what other programs through the government that are crazy successful? The SBA is probably one of the only ones that is, but why? It's not because it's facilitated by the government. It's because it's facilitated by prudent lenders, banks, credit unions, non-bank lenders, CDCs. It's facilitated through them and not necessarily the U.S. government, who could just sign a check and go on about their way and don't think about the implications of their job, so to speak, which is very different than us as individual lenders.
Yeah, okay, that's the best point I've heard made. Something's actually working in the government. Let's not mess around with it. But I'm gonna keep trying. Ken, pretend the 504 program didn't exist. If at any point during the last 15 years, a politician said, we're going to create an entirely new SBA program that offers a rate that's 4 to 6%. Now, keep in mind, prime's been between 3 and 8 for this period of time. And we're going to use a network of CDCs to provide these loans, but they need to get banks to offer conventional loans in conjunction. And we're not going to fund ours at closing, so they're going to need to do an interim loan too. Do you think they would have been able to sell that idea at any point during the modern history?
No. This program has been around a long time, and is it perfect? No. Do you have an issue like the bridge loan that is a challenge? Yes. Do you have multiple lenders involved when you talk about CDCs and banks and the interim and yada, yada, yada? Is it confusing to borrowers? Yes. Is it perfect? No. Is it working? Yes. Did it take a while for it to work? Yes. Like a long while, like many, many, many years. But now, over the last 10 years, it's actually worked pretty well. So if you said never had it before and want to start it from scratch, people would think you're crazy.
All right. Well, we can pivot a little bit away from this, and I'll talk about something else real quick on the regulation standpoint. Mitch, since we are kind of doing this, do you think lenders are responding more to like clear-cut rules on what you can and can't do? I feel like there's a little bit more of that with the 504 versus 7A. I think having a little bit more gray area, especially as we're moving towards the do what you do stuff. What do you think is the preference for the lenders involved in these programs?
So that's a really, really great question, more than you probably think it is, because lenders come in many different shapes and sizes. My firm represents some of the biggest, most sophisticated 7A guys and CDCs around. And we also represent, little community banks who really have no way to figure stuff out. Do what you do to them, that doesn't mean anything. So they'll engage like LSPs and they'll engage us to help. My role as a lawyer in closing deals has morphed tremendously. When I got into this business years ago, it was like, here's a deal, Fogel, don't screw it up, close it, get us our lien. And then over time, particularly after the recession in 08, 09, the few surviving firms like mine that had a good foundation, we were kind of asked to be more advisors and interpreting SOP more than ever before and understanding and all. And the SOP didn't change. Ken can comment on this, but I think the SOP was pretty stagnant for almost 10 years, maybe 12, maybe 8, but a long, long time. And then it was changing every year. It was like incredible. And that's still going on because of the do what you do. So to get back to your question, there are those that need a lot of handholding and they feel comfort in that because they know that they need that guarantee to be there. When you have, a small bank on the west coast of Florida, for example, that's doing, a dozen or 15 7As a year, they can't afford to take a risk that they're going to lose a guarantee. They could never digest that. When you get big boys or girls up there, they can take a hit or two and they're okay. They're willing to take a risk, PLP status notwithstanding. So we kind of bridge the gap for them a lot, my firm, and firms like mine. I don't know how many of us there are, but there's certainly 5, half a dozen of us, maybe more in the country that have developed an incredible sense of knowledge in this industry after many years that we can kind of provide a service that we didn't do before and help the smaller ones get through it. But I will tell you, in my firm, I'm doing a deal with a bank right now, and they're making, I think, a bad decision. They're willing to take on a risk I don't think they should. And one of my attorneys in my firm and I went back and forth, and we posted an incredibly well-thought, drafted email to them to explain to them why we felt they were doing something they ought not to be doing. They make the decisions, do what you do. So they get to make the call. We'll close a loan, we'll cover them, we'll get them what they need, but they make the choice in doing that. They are a decent-sized regional bank. They'll do it. Other banks won't do it. So it's not a one-size-fits-all. Some of them do like the guidance. Some of them don't take any guidance. They hire super talented, smart people, bring in what I call like the savants who have been doing this like as long as Ken and I have, maybe longer. Some of them have worked with the SBA, so many of them have run departments before. They bring them in as consultants, and they basically build their team around them. And so they're willing to take risks because they can. So I think to do what you do in a way was kind of a good turn to make. I didn't at the beginning. I do now.
Okay.
And the reason I do now is because it really does put the burden on the bank to do their job and to take a look at things and decide what risks they're willing to take and if they're not, as opposed to just relying on the SBA guarantee, which I never liked anyway. We practice a very practical but conservative way of getting our deals closed. Yeah. But there are some that, like I said, don't know what that means, and so they do need help.
That's an interesting.
The SBA is there to do it.
That's an interesting and well thought out take. Because as time goes on, it's like, we're kind of digesting this. So that's interesting. That's a little bit of an emerging thought that kind of resonated with me. Okay. So I got rid of all my other questions that I wrote today on the plane, but Brooke, pivoting, let's use the word pivot here. If not my idea, what is your idea for your program? I don't think there's too much on the agenda for 504 changes right now, right? But like if you could really get creative and think of one change that you could make to the program, what would it be?
That's tough. You should have given me that one earlier. Like, 4 days ago. So Ken's idea, that thought, I mean, we've talked about that at NADCO, separating the 5 million and not capping it out for our small business owners. Cause when you get too big to get this type of financing, that's, I think that's always the concern for SBA. The other thing is there's been some, in the last few years, there's been some pretty big changes, especially in debt refi. Which honestly couldn't have come at a better time with interest rates in the 7A, going up so fast. And I would always explain to people when you first, start a business, sometimes you're, looking at angel investors, then you're looking at venture capital, you're looking at, there's ladders and you get to, SBA 7A, then 504, you're buying real estate, and then you get conventional, and then you're buying, your cash, right? So, there was always this way where you could just keep going up the ladder, and with 7A, you can buy real estate, but for 504, you couldn't touch a 7A. And so until a few years ago, it really opened up the ability for these business owners. And again, perfect timing, talk about what interest rates, I think went up 5% in 13 months. And you think about your, it's not just like investors not getting their money. It's more just, man, these business owners, their capital needs are just getting squeezed. And you imagine if they haven't saved and done their due diligence throughout that time period, they're not going to have the funds to make those payments. And then they want defaults. And if you've seen the 7A default rate right now, it's continuing to increase and increase and increase. And there's reason for that. And so, for 504, if I were to say anything, like I like the idea of, I wish there were more opportunities for 7A refinance, meaning when a 7A did, I would love to see it 51%. If 51% of the 7A loan was done in real estate, you can be able to flip that to a 504, assuming the collateral is available, and so they can capitalize on it, even if it's just a straight refi. Maybe you have 51% to 75%, no EBE, eligible business expense cash out, something like that, where there's some flexibility there where they can just do a straight refi, get out of a variable rate, assuming the fixed rate's a better product for them, and allowing them now to get maybe a 7A for just working capital or what they might need it for.
Interesting. Okay. Ken, it's not about 504 versus 7A. It's about making the pie bigger. And I think we do that by thinking outside the box and making big improvements to the programs. We have under 1,000 banks really getting involved in the 7A. There's more that's actually made, but a lot, the bottom, a couple hundred makes like one or two, and that doesn't really count. So you have, 20% of banks really getting involved, and probably less. So if it's not creating a new program, what other big picture idea could we use to spread the 7A and 504 program to the rest of the banking community?
It's an interesting question, and it is a huge challenge. So I travel the country trying to basically convince community banks to get more involved in SBA 504 lending. And using the wholesale market was an option for them because they can't compete as they are now. we're not that successful, honestly, with the community banks. And I don't think that the Centaur program or the 505 and 7B, where each has a 5 million, or Mitch, 10 million each, is going to solve that. The rich keep getting richer, the big keep getting bigger. Those that do it understand it and understand the benefits of it. And the only way you're going to have this happen is you have somebody like a Ray go to a credit union that does credit unions don't do anything. And all of a sudden, somebody who's an SBA lender goes to the credit union, and now they're doing volume. So you have an experienced SBA person go to a community bank that can barely spell SBA, and they'll do volume because of the people. So it's about training good people and having them spread out amongst the country and you go into a credit union is a perfect example and not normal, right? You were a non-bank lender guy. So if you have more of you going to across the country to credit unions or community banks, leaving the big banks or leaving CDCs, going to the private sector, spreading the 504 gospel, so to speak, the 7A gospel in your world, that's what's going to make a difference. The same usual suspects will create the same usual results. Insanity is
doing the same thing over and over, expecting different results.
Yes.
All right, guys. Well, I am going to go ahead and admit on record, I'm going to withdraw my proposal for the Centaur program. We will continue as we have been. But thank you so much.
We're still okay with 505 and 7B.
Beautiful.
That's the shared one. Each one get a 5 million cap.
At least, yeah.
Oh, okay. All right. 505, 7B. Sounds like a plan to me. Thank you guys for being with us today. Until next time, ta-ta. All right, that's it for this week's episode. If you want more SBA content, you can sign up for our monthly newsletter and check out our sister shows, SBA Today and The Video Show. We'll leave a link in the show notes. And don't forget to subscribe to this podcast so you never miss an episode of the Art of SBA Lending. Ta-ta.